Well, happy Thursday. We have got an amazingly packed hour to share with you. I know Megan is going to be diving deep into the numbers. This housing market is a little hard to get our arms around right now. So we're going to go knee deep in the numbers. I'm going to talk about the economy. You talk about a week. Oh my gosh, I have things to share with what the Fed did, what the GDP came out, all the other news, and where's the mindset of your buyers and sellers right now? How are you communicating with them? Because sometimes I just want to put the blanket over my head and go back to bed, but we can't do that. We have to stand up tall. We have to continue to message. And that's where my quote came from today, because I've got some fantastic news on the rate side. We're going to look at that, all the charts on where the 10-year yield is going, as well as the bonds, and what you can expect to have happen the rest of this week and next week. But if you're not communicating with your buyers and sellers right now, if you're not staying in front of this, if you're waiting for something to happen and the business to come to you, then this year's going to be hard, because the second half of this year is going to be really wonky and a bit slower, trying to figure out how do we get into this recession and then back out of it. Because remember, we're always headed towards a recession. It's just a matter of how close it is. This is a cyclical economy. So here's the quote. It's short and simple. Success is a sum of small efforts repeated day in and day out. How do you wake up every morning? What do you do? How do you set up your day? And who do you contact and how? We had a fantastic agent ignite last week. Holy smack.
We had 200 people in person.
Yes.
And then we had another 600 online.
Oh my gosh.
And so we had 800 people that attended basically last week.
And so not only did we talk about what's going on in the economy, but then Mike Schroer joined us and talked about video and doing it, just simply doing it. I had a ton of you doing it and tagging me, and I loved it. So keep doing that. This is it. It's the small steps every day, talking to your clients and letting them know what's going on. They need you now more than ever. Miss Megan.
I love that. I love that quote, because it was when I first got into sales, I felt like there was this huge ebb and flow in my productivity, and I couldn't get it streamlined. And so my boss at the time told me, focus on your activities and not the outcome, because you'll always, if you focus on your activities, the business will come.
Always.
And so now I've got my goals, and I know how many contacts I need to make each week, how many appointments I need to set each week. I have my reports dialed in. And so time blocking is my friend. And this is a market where you can actually time block again. We're not at the mercy of what hits the MLS every single day. Again, this is the market that we've been praying for 2 years, and the market has really shifted on us. I've been making more efforts to get in touch with my database. And so this week I reached out to my top 50 clients and asked them what they're doing in order to shift along with this market. And there's a lot more marketing that goes into getting a home ready for sale.
Oh yeah.
Where it's more than just putting it in the MLS and taking drive-by photos of it with your thumb over the camera as you're driving by the property. And so I'm hearing a lot of people
that doesn't work.
Drive-by shootings. No, they don't work.
Drive-by shootings.
So I'm hearing
anything that you heard that surprised you?
I'm just hearing a lot more effort going into getting the listing ready up front, where they're offering staging, they're offering whole home cleaning, they're cleaning the windows before they go through and start showings, offering a home warranty automatically with every one of their listings, professional photography, including twilight photos, a better 3D tour so that people can see the home 3D in the dollhouse view through some of the different, what is that called, Matterport, but then also doing reverse prospecting to make sure that those listings are getting out there and that people are actually seeing their listings now. And so I'm hearing a lot more people that are putting a lot more effort into getting their homes ready up front. And when those people that are putting more effort in up front are still going under contract in the first weekend. And so there's a big difference between people who are putting their homes on the market that are ready to go versus those that are just taking photos and hoping that something happens when they put it in the MLS. And so
I'm hearing folks doing the inspection ahead of time, and then even fixing that. Here's the list of all the things that we fixed from the inspection. Here's the inspection report. Being proactive. And then it's interesting, I was talking to a listing agent who had very few showings, no offers the first weekend, then multiple offers, had a jam-packed second weekend, multiple offers went over asking.
I'm hearing that story a lot too, where
Yes.
they're not getting a lot of traction in the first weekend. And so don't freak out because median days on market now is 11. So it's sitting through the first weekend at this point.
Yeah.
And so again, you have to prep your sellers for what's going to happen in this market and really get that home ready to go for the marketplace. And so there's a lot more effort that goes into this market. And this is where the cream rises to the top, where people who are willing to shift with this type of market change are the ones who are going to come out on top. And so you really have to change up your business strategy. And we're seeing a lot softer pricing right now.
Yes.
I had some stories that came back that were people were talking about, well, I had taken the listing back in March, but they didn't want to go active until June or July. And they had to go back through and revamp all of their pricing strategies because they were going to be overpriced if they presented their home to market at the same prices they would have in March. And so I've seen about a 3 to 5% pullback in average sales prices from peak pricing back in March.
But you can't woulda, shoulda, coulda yourself. Like, unless you were planning on selling like an investment property that maybe has tenants, so you're kind of locked out of selling it. I was talking to another client who had a listing, or she wanted to put on a listing that was an investment property, but those tenants didn't leave until spring, but she wanted to use that money as a 1031 exchange. Well, it just so happened that those tenants just requested to break their lease. So the timing worked. Sometimes things work out exactly how they're supposed to. But I was talking to her about the fact that, yes, she could put it on. It's a really hard toss up because you'll get more options is what I was going to say, but more opportunities as well if you sell it without the tenants, because then a primary home buyer can buy it too. And there's so many primary home buyers looking today that need a home.
So I just had a question. Did you call, email, or did you call or email your top clients? And so I called some of them and I emailed some of them, just depending on who the client was, just to get some feedback on who that was. And so, yeah, it was a call or an email, depending on who they are and how they like to be communicated to. Yep. And so I get worn out. I'm not a great phone person. I will tell you, I am not great on the phone. It takes me a lot of effort to get ramped up and
do
on
you
the
text
phone.
them? Or just email? You're not a texter either?
You know, texting gets lost on me and I end up getting so many of them back that it ends up being too much.
Yes.
And I think that if it's more than 1 or 2 sentences, it needs to be an email and not a text message.
It's a diatribe is what
that
is.
Like, it just becomes like paragraphs long in texting, and it becomes too much.
Don't text diatribes.
Yeah. No. Not at all. So let's go ahead and hop into the numbers for this week. And this covers the week of July 26th through July 20th through the 26th, looking at all of our sales strategies, going through and again, talking out to those top 50 clients. Here's our heat sheet for the week. Again, this tracks the inflow and the outflow of business as I'm going through and taking a look at what's happening in the marketplace. And so I track all of the new listings that are coming to market, how many are active, how many are going under contract, showings, month supply of inventory, all on one sheet. And I go through and I color code that for you so that you can see as the market is heating up or cooling down. And again, there's no surprise here. The really hot months were back January through about the beginning of April, and then Easter weekend hit and our market really pulled back. And each weekend that I tack on a new row of cells, we've got more and more inventory that's making its way to market. And it's not that it's more inventory is making its way to market, it's that inventory is aging in place and it's staying on the market longer than one weekend. And so our inventory is way up. We have roughly 6 times the amount of inventory now that we did back in January and February, creating this market shift. And again, it's not because we have significantly more new listings coming to market. It's because we have inventory that's not going under contract. So it's hanging out for longer than one weekend.
But compare that too, right? I mean, we consistently want to compare that back to 2018 and 19. I mean, to have 6 times the amount of inventory as January was anemic.
Yes.
It was unhealthy.
Yes. We didn't want that.
No.
That was a really tough market to work in. That was a really tough market to work in. And so looking at our month supply of inventory, we're now up to 1.3 months worth of inventory, which is where we were over Independence Day weekend. And so this number continues to climb each week as I go through and I add on each week after that. And so again, our market is really slowing down as compared to where we were earlier this year. And so it's important that you guys are making those homes as show ready as possible and getting your listings really presented to marketplace in a nice, pretty package so that it's one of those that goes under contract in the first week. Coming soon fell by 15.2%. So again, it's not because we have a lot of new inventory making its way to market. New listings were down by 16.1%. It's the inventory is aging in place. Our active inventory went up by 6.9%, and we're sitting at 6,300 average daily active count. And going into this weekend, we actually have about 6,500, 6,600 active listings going into this weekend. Pending transactions came up ever so slightly this last week by 1.9%. So a little bit more activity out there last week with units going under contract. I had a lot of questions pop up this week. Do you think that there's going to be a pop this weekend in light of people trying to get ahead of interest rate hikes? And so did
Well, the interest rate
go-
just hiked,
Yes.
right? But the
Mhm.
interest rates aren't. They actually got better.
Mhm.
And so I wanted to add that to you because if we've got, what did you say, 6,600 active inventory going into this
6,600
weekend?
active inventory.
We've got the best rates that we've had since April
Great.
on the way up, right? Not on the way down. So, and I'm going to show you some charts in the second half that tells me that I'm a little worried about how long these low interest rates are going to stick around until we really do get inflation under control or until we really do go into a recession. These are the kind of moments that you've got to take advantage of and not sit around and go, oh, well, the interest rates are dropping, so I'm going to wait.
Right.
No, 6,600 active inventory plus low interest rates means get to work.
Yes.
Right. I mean,
So get
this
out
is
there.
the weekend
Get out
that we
there.
need to get to work.
What's the 30-year fix sitting at right now?
Oh, it is lovely. I'm going to show you that in a minute.
Nice. You're gonna hold out on me.
I
and
am
You're not
hold-
gonna let me steal
I
your
am
thunder.
holding it. No.
Nice. So again, lots more inventory out there right now. And so if you have those buyers that got knocked out of the market earlier this year, now is a great time to circle back to them and let them know that they have more negotiating power right now than what they've had in the past. Looking at numbers from May to June, in May for closed transactions, it was 70% of them went for over asking price versus closing in June. It was only 20% of them sold for over asking price. So again, the rate of multiple offers has calmed way down. So now you can maintain your inspection, your appraisal. You have the right to negotiate through those points. You're likely to be able to use an FHA
Yes.
loan, a
And down
VA
payment
loan,
assistance.
down payment assistance, a contingent transaction. We're seeing a lot more of those come through now. And so it's important that you guys are circling back to those people that weren't
100%.
successful earlier this year.
We've got a borrower right now that has an FHA first, a CHFA second, and a CHAC third.
Oh my gosh.
You can do that, and you can do that right now. I mean,
Nice.
talk about a major win for this client who could not get in the market the last 2
Mhm.
years.
Great. And so the odds of selling came down this weekend. It ended up dropping down to 56.5%, which is below where we were back in 2020. We're looking more closely at like 2018 and 2019, but this number is likely to continue to deteriorate through the end of the year. So if you have listings that you've been waiting to get to market, the moral of the story here is get it to market as soon as you can so that you maintain as much of that buyer pool as you possibly can, rather than waiting until September, October, November when the market's really going to cool off. But 56.5% odds of selling is basically where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And I project it forward for a 4-week period of time, but this market has really cooled off. So again, you have to set the stage for your sellers, understanding that you might not be under contract in that first weekend, like what you were earlier this year. I just accepted a contract yesterday for a new title order, and they'd been on the market for 48 days and did 2 price drops to go under contract. And so again, we're starting to see those price reductions really ripple
What was
through
the
our
price
market.
point on that one? Do you
It
remember?
was a $600,000 house in Lakewood.
You're like, okay, that
Yeah.
used to be the sweet spot.
Yeah, it used to be
Yeah.
the sweet spot. Based off of the number of units that went under contract last week, we were looking at about 30,000 units to make a balanced market. We're sitting at about 21.2% of a balanced market right now. So we're not expecting a market crash or a market correction. There's a seasonal shift that goes into play where we see prices fall back every year from July, August, and September. Typically, home prices end up falling back between 3.5% to 5% between July, August, and September. And it's due to that relationship shift between supply and demand. We see supply going up in the summer months and demand going down because we see the bulk of our transactions going under contract between January to June. And so we end up seeing this fallback as people start to relax in the marketplace. Buyer fatigue sets in. And this year we had an affordability issue where interest rates went up and we had extreme price appreciation in the first part of the year. So a lot of buyers got knocked out of the buyer pool. And so again, we're still far from a market correction. People are flush with equity. So we're not concerned about short sales, foreclosures, or HUD homes coming to market. We've seen more pre-foreclosure listings coming to market, but they're so flush with equity that if they go, they're likely to still sell in a hot market.
Right.
And the seller is able to walk away with that equity, so it won't turn into a foreclosure or a short sale. We're also don't have anything that's going to cause a major impact to unemployment. Unemployment still sits at 3.5 to 3.6%. So as long as people are safe in their jobs, we're not concerned about a major loss of jobs coming up that would cause people not to be able to make their mortgage payment.
So there'll be some job loss, right? I mean, that's kind of part with a recession. But we're going to see more job loss at the lower wages. So a lot of those they don't own, which is just adds worse on worse, like your heart breaks for those folks. But we will see some job loss because that's just natural. But it really is exactly what Megan just said, is we have so much equity that all they have to do is sell. And really, you're going to hold on to that, because if you have a 2.625 interest rate and you've got $150,000 in equity, and what are you going to do? You're going to turn around and rents are still going up. You're going to do everything you can to hold on to that house. You're not going to just let it go.
Right.
And foreclosures are still, FHFA or Freddie Mac just came out with their foreclosure number, and it continues to go down. So we're seeing a slight pickup in foreclosures, but they're not conventional loans, interestingly enough.
Yeah.
So there you go.
Looking at the rate of showings this week, there were about 14,000 total showings that were set. And if the average buyer is looking at 3 to 4 homes each weekend, that means that we have roughly 5,000 buyers available in our marketplace right now. The average buyer, the average new listing that went up for market last week got about 2.2 showings on it, which is down from the previous week by about 5.6%. So showings continue to taper off, which is a stark contrast to what we were seeing back earlier this year, where we were seeing 24 to 26 shows per property per weekend. And so again, we're down to about 2.2 shows per property per weekend, but we still have a very healthy buyer pool that's out there. We're still looking at about 12 showings to go under contract. So again, on an average price listing in Metro Denver, around $800,000, you could be on the market for as long as 6 weeks before you go under contract. So you really have to prep your sellers for spending more time on the market. I always think about those poor sellers and I'm like, could I keep my house clean for that long? Because I've got 2 little kids and toys strewn everywhere.
You just go Airbnb.
Oh my gosh. Trying to keep my house clean in this market would be really hard for about a 6-week period of time. Median days on market popped up to 11. We've been hovering around 10 or 11 median days on market now for about 4 weeks. And so again, it's taking longer to get people through these homes. We're advising that you're waiting to make price reductions instead of earlier this year. If you weren't under contract in the first weekend, we knew that there was a pricing issue, whereas now it's weekends number 2 or 3 that we're looking at making price reductions. And so slow down the rate at which you're making price reductions. Again, it's 12 showings to go under contract. So if you've had 12 showings and no contracts, now it may be time to consider a price reduction in our marketplace. But median days on market is starting to get closer to 2 weeks, and this number is likely to continue to stretch out as we get into the end of the year. The rate of price reductions was 36% of all the units that went under contract last week made a price reduction. And so we're starting to see more price reductions roll through each week. And so again, if you're waiting or sitting on the market and you want to get it sold before the end of the summer months and you've had your 12 showings and no offers, it's time to get something, it's time to get it priced right appropriately. We're looking at about a $46,000 average price reduction right now. We're about 6.1% in our market. And so again, I'm starting to see larger price reductions go through in our marketplace rather than the henpecking where we see a series of smaller price reductions. We're seeing people make bigger, deeper cuts in order to get back in front of the market right now. For the under $500,000 market, this market has started to cool as well. It cooled a little bit later than the rest of the market. This market has remained pretty hot up until about June. In June, it really started to pull back, where we started to see more listing inventory sit in age on the market than what we had seen earlier this year. We're now sitting at 0.7 months worth of inventory, which is up from the 0.1 months worth of inventory that we saw earlier this year. And so since this number is below 1, that means that we're still likely to see multiple offers in this market. And so 0.7 months worth of inventory is definitely a lot longer than what we were experiencing earlier this year. Our average daily active count came up by 13% just from the last week, and our pending transaction count rose by 2.2%. I'm not seeing a ton of back on market activity, even though it did rise by 19.4% in this past week. That's more likely due to units that were expired or withdrawn coming back to market than units falling out of being under contract. And so again, inventories on the rise. We have about 1,300 active listings right now that are in that up to $500,000 market. The odds of selling hasn't tapered off quite as drastically in this price range as what we're seeing at higher price points. We're now at 68.6% odds of selling, which is on pace with where we were back pre-pandemic in 2020, more on pace with where we were for the last 10 years as we get later into the summer months. Looking at where we should be for active units for balance, we should be around 11,000 active units for balance. So we only have 12.2% of the inventory that we require to offset demand. It was an average of 3.5 showings per property if you put up a new listing in this market for the under $500,000 market. And again, it's about 11 showings to go under contract. So you could be on the market for 3 to 4 weeks before you go under contract in this market. Looking at median days on market, it stretched out to 8.5. So we're looking at about a week, just over a week on the market right now. So again, it's taking a little bit more time to get people through these homes. And so it's been bouncing between 7 and 9 median days on market since Independence Day weekend. So again, it's roughly doubled since where we were back here at the beginning part of the year. The rate of price reductions was 28.5% of the units that went under contract last week made a price reduction. So we're seeing more significant price reductions, even at lower price points as well. Average price reduction in this price range was about 5.3%. It's been bouncing between 5 and 6%, or about $24,000 off of the original price to go under contract right now. In the $500,000 to $1 million segment, this market again really started cooling back here, more so in June, where we really started to see that pullback. It started cooling right around Easter weekend, but it really started to become much less competitive as we got into June. We're now sitting at 1.4 months worth of inventory, which is up from the 0.2 months worth of inventory that we saw earlier this year over Super Bowl weekend. We have about 4,000 average daily active units, and that's up by 5.1%. And I thought this number was really interesting. It's up 145.4% from where we were 1 year ago. Last year, we had a really extended selling season because interest rates were so low. Our market happened earlier this year. And so again, it was those sellers that were ready and on board to list their home in January, February, March, and the beginning of April really reaped the benefits in this market. And so you have to pull back on your pricing strategy because of that relationship between supply and demand has shifted so much.
So not only did interest rates go up they started to go up in January, then they really went up in March, but we also had a massive wealth effect shift, right? I mean, people were feeling pretty dang rich last year. If they had money in crypto or the stock market, that hasn't panned out as well. Now the stock market has done pretty well. What was I just seeing for the last 7 weeks? It's not doing well today, but regardless of that, it's not doing well this year compared to what it did the last 2 years. So that impacts this tremendously. People were buying anything.
And definitely it's as we go up in price point, people who are watching their stock markets, their stock accounts, we tend to see a bigger drop off at higher price points when you start to see fluctuations in the stock market. And so again, keep that in mind with your higher priced homes. It was down to 53.9% odds of selling, which is again lower than where we were pre-pandemic, where it was sitting at about 61% as we went into 2020. It's back on pace with where we were from about 2013 through 2019 at this point. In this market, we would need to have about 17,000 active units in order to create a balanced market. So we only have 23% of the inventory that we require to offset demand. If you put up a new listing last week, you would have had 2 showings on it in order to benchmark with where you were. And again, use that target market analysis out of showing time to try and figure out how many showings you should be getting out of your market as you put up a new listing so that you can set appropriate expectations for your sellers as to why it's not getting as much traction as it was if it would have been listed earlier in the year. Again, 12 showings to go under contract, so you could be on the market as long as 6 weeks before you go under contract. 14 median days on market, so now we're looking at about 2 weeks, which is up from the 4 median days on market that we were for the first part of the year, but it's taking about 2 weeks to go under contract with half of the homes right now. The rate of price reductions increased substantially. We were looking at about 41.3% of the homes were making price reductions. The average amount of a price reduction that we typically see in July is about 20% of homes make price reductions in July. So we're seeing price reductions at a rate of double what we typically see for the month of July. And so again, 41% of everything that went under contract last week had a price reduction. Average price reduction was about 6.1%, or about $45,000 off of the original price to go under contract.
And you said the lower price point below 500 was 25,000?
Yes.
And this price point, we're seeing 45,000.
That's significant. Those are big price reductions. In the 1 to 1.5 million dollar market, again, it's continued to cool. Cooling trend really started to settle in May for this particular market. It had a little bit more of an extended selling season. Right now, we're looking at about 594 active units, and that's up 10.4% from where we were just last week. Pending transactions fell week over week by about 15.7%. So this market is cooling a little bit more. We now have 2 months worth of inventory. So for every one buyer out there, they have 2 homes to choose from, and that's up from where we were just the last week by about 30%. So we saw a big decline in the number of units going under contract in this market. We're looking at about 46.1% odds of selling, which is again back to where we were back in 2020. Looking at where we should be for market to have a market in balance, we should have about 3,000 active units in this market. So we only have 21.7%. So we're still not looking for a market correction in this $1 to $1.5 million segment. Again, about 2 showings per week at this particular price range. And it's taking about 14 showings to go under contract. So you could be on the market as long as 7 weeks before you get enough units or before you get enough showings to go under contract. So again, slow down the rate at which you're making price reductions. I would say wait until weekend number 3 or 4 before you make a price reduction to make sure that you're getting enough people through that house before you decide to reduce that price. Median days on market came down. We were sitting at about 10.5 or 11 median days on market. That's down from the previous week where we were sitting at 19.5 median days on market. 38% of them made price reductions. So there were actually fewer price reductions that were made this week for units going under contract. That was down by about 12.4% from the last week. We're seeing about an average price reduction of $118,000 for the $1 to $1.5 million mark, or about an 8.4% price reduction. In order for you to make a substantial price reduction in the $1 to $1.5 million mark or $1.5 to $2 million mark, we're looking at hundreds of thousands of dollars of price reductions right now in order to get it under contract. 1.5 to 2 million. Again, this market is cooled. We really started that cooling trend back in May, where the market became much less competitive than it was before. We're now up to 2.7 months worth of inventory, which is the most that we've had since we were back actually in quarantine, right before we went into quarantine pre-COVID. And so we had about 214 active units, and that's up by 3.4% week over week. Pending transactions actually grew this last week by about 5.9%. So 18 units went under contract in the $1.5 to $2 million price point. We're seeing more new listings make their way to market. It was actually up by 3.1% from the last week. Looking at the odds of selling, it's 42.8%, and that's still higher than what it was pre-pandemic. So we have more buyers in this market still than where we were back in 2020. We would need to have about 1,000 active units in our market. So we still only have about 22.8% of the inventory required to offset demand. We're still looking at about 2 shows per property per week at this particular price range, and it was about 20 showings to go under contract. And so that means that you could be on the market for as long as 10 weeks before you go under contract if it's taking 20 showings to go under contract. And that went up pretty substantially by about 5.8%, where it was about 14 showings to go under contract last week. We're looking at about 14 median days on market right now. And so it's taking a little bit longer on the market. We were looking at 4 to 5 median days on market back earlier this year. 38.9% of what went under contract last week made a price reduction, and the average price reduction was 10.5%, or about $206,000 off of the original asking price in this particular price range. And so again, much more substantial price reductions are happening right now. If you need to get something under contract before kids head back to school, we'll really see the next big pullback as kids head back to school in the middle of August, and then really a big pullback again after we go into Labor Day weekend, where people start to withdraw their listings from market in favor of listing their homes next year for sale. And so again, the market continues to cool off. It's a great time to be a buyer in this market because you're able to maintain some of your rights to inspect and to object. And so again, it's a great way for you to get back in front of those buyers that got knocked out earlier this year.
So Kelly's also asking how low the rates are. We're going to talk about that in just a second. What about the October through the end of the year for seasonal drop? Will it pick back up again?
So I don't know that it's going to pick back up again. I think that it's probably going to continue to taper off. I think that the bulk of our transactions happened early this year. And so I think that I don't expect there to be a big pickup in our transactions as we get into the later part of the year. Oh, go ahead.
In fact, I'm a little worried. If we did see a lot of our activity in the first half of the year, if sellers pulled their inventory up, we're going to have very little for sale. So especially buyers, because that's who I talk to all the time, need to get out there and look. And then Eddie.
Yeah. And so question about, yes, I sent out a copy of the graphs each week. And so in my signature block, if you ever email me, there's a way to download that report. And when I email you the reports, go ahead and bookmark that page, because it's always the same page that I post everything to when I go through and update those graphs.
So question on initial pricing. Can we still go under FMV? You probably know what that is. I don't know what that is either. knowing that brings the largest buyer pool, with market auto correcting and bring potential multiple offers. You're going to have to explain to the non-real estate agents.
Yeah, I don't know what FMV is. And so, yes, you do have to pull back on your pricing strategy. I'm hearing most agents pulling back about 5% from where we were off of peak pricing.
Yeah.
If you're pulling back on your pricing strategy, it is still drawing out multiple offers based off of data that went under contract and closed in the month of June. If you went under contract in the first 7 days, if you price it right the first time, it sells faster and for more money, that it was going for about 4.7% over the original asking price.
Can you remind me where you find the showing info that you use in showing time?
So in showing time, go to reports. It's called the target market analysis. You can do a zip code and a price range. Is a great place to go.
Any info above 2 million?
So above 2 million, I can't track on a weekly basis because there's only a handful of listings that go under contract each week. I do track that in the monthly reports, but I have enough information so that we can get those through. And so looking at the over $2 million segment, we're probably sitting at about 3 months worth of inventory right now. In the $5 million segment, we're sitting at about 5 months worth of inventory right now, which is not a bad number. I always like to compare that back to 2010 when we were at the bottom of the recession and when we had like 5 years worth of inventory. And so again, it's not a bad market. It's definitely shifted though from where we were earlier this year.
Thomas, fair market value. There you go.
Oh, fair market
FMV.
value.
Thank you.
Yes.
Okay. And then Kelly's asking because she's got some sellers that can't list until October because they're getting married. I mean, it's so hard to tell the crystal ball with what's going on with the economy. If we do drop into a recession,
it could help if we see that normal retraction of inventory as we go into September and October. But it's still, you have to go softer on your pricing strategy than what you would have if you would have been listed in the spring.
Crystal ball for spring. That's even harder. I
think it all depends on what happens with rates.
Oh God.
I think that rates are going to be the big determining factor.
If we land our inventory at the end of the year less, because I feel like we might, if we pulled inventory early and over the fall, we spend it. And so if we end the year with less inventory and we go into the spring and we do hit this recession, then we're going to see lower interest rates on less inventory, which is going to see multiple bids. Those first-time home buyers aren't going to be able to get back in again. It could be really good for sellers, but I mean, how long do you put your future on hold? I mean, that's what I keep getting back to. I mean, if you're trying to sell something on the market that's an investment or second home, maybe you play the timing game. But for everything else, if you got to turn around and buy something, you're buying and selling in the same market. It is going to be a little bit harder, but I think we're going to see a recession. I think we're going to see interest rates drop. Can I receive those emails?
Yes.
If you signed up for this,
you are on my distribution list until one of us dies.
Both of us.
Yeah.
I'm sorry.
Yeah.
I'm not sorry. I'm sorry. We talked about the fair market values. It's safe to say that we need to start comparing the rest of 2022 to 2019 since 2020 and 2021 were such anomalies.
Yes.
I'm not even sure the rest of 2022. Yes, I've been comparing to 2019. I'm afraid the rest of 2022 is going to look worse.
Yeah.
But don't ignore 2020 and 2021. The year over years are a little bit distracting. Okay. We actually got through all the questions.
There were a lot of questions.
You guys
today.
did good. All right. So I'm going to jump into done and done. I'm going to jump into our slide deck. We have a ton. And between Megan being outside, her technical issues, my technical issues the week before last, before we had Mike Sherrard, I know that I was fumbling and did have I ran out of time. I had to hurry up and talk faster. So this time though, I have just as much to talk about and hopefully we'll get through all of it. I'm not going to try and speed up everything I'm doing, but at the same time, you guys got to know what's happening because there's a lot happening. So let's minimize the little picture in picture and get this bigger. Okay, here we go. Sorry. Oh, I haven't shared my screen. Haha.
That always helps.
I'm just like, whatever, we're having fun. All right, so here we go. So what do the 10-year Treasury, Powell, the ECB, Walmart, purchase applications, consumer confidence, and the GDP all have in common? They all happened this week. My gosh, it was a full week. And all of it, like you could go dark. And I saw a lot of negative headlines. You could go dark on any one of these. And I'm going to show you the numbers. And some of them, I've even got some new build numbers in here and pending home sale numbers in here. but I could go and talk about the fact that the economy is slowing, housing is slowing. Are we hitting a recession? At what point do we hit the recession? The Fed just raised their Fed rate. The cost of borrowing just went up, not the 30-year fix, but the rest of it, the HELOCs, the credit cards, the personal loans, the car loans. So that all just went up. The cost of borrowing is up. Business spending is down. All of it. It was a lot this week. It was a lot this week, and it could be really disturbing. And if I didn't do this all the time and kind of geek out in it, I might just say, I'm done. Like it's a lot. And I don't know. And I hear that prices are going down. I hear that interest rates might be going down. The recession's going to happen. You know what? I got to just tune out and I'm just going to wait. Well, this is the moment that, what do all these have in common? To me, opportunity. They have opportunity, because whether they're positive or negative, it's opportunity to have conversation, right? I mean, you can have a conversation about the negative data as well as the positive data.
Well, and the fact of the matter is that people have to move.
Yes.
Birth, divorce, death,
Yes.
change of
It
job.
keeps happening.
Like it just keeps happening, and there's always a reason for people to be moving. It's just finding those people.
Finding the people. Yes. Get on video. So yeah, no, you got to just find the people. And we got to remember that the largest age group right now is 30 years old. We know the first time home buyer average age is 33. We still have demographics working in our favor. They're just a little worried. And if you were at the presentation last week, you know, they're willing to give up almost everything, including social media, to get into the perfect home. So, and alcohol. That was, I'm not willing to get alcohol. Yeah. You know, you get tired of it when you're 27, but then you need it again when you're 53. It's just kind of a thing. It's a cycle. All right.
You're in real estate.
Or you're in real estate, right? It's the rest of us. All right. So here we go. We saw the 10-year drop this morning. I just grabbed this and we saw a 2.67. In fact, when I first started to grab it, it was 2.66. It's moving very slightly. And I want to kind of show you, we were in a range where 3%, we were hovering just under, just over 3%. And it's where we've been since the middle of April. We have dropped. This last week started on Friday, and that's the news. I'm going to show you from Friday to today what's happened that's giving us this massive benefit to the 10-year Treasury yield, right? So this is not bond prices. This is the opposite. It's the yield. This is comparative to the 30-year fixed interest rate. So to see that drop is great news for us. 2.67 is phenomenal. And I'll give you a little bit of I'm going to show you the interest rates here in a minute, but we're locking as low right now on a 30-year fixed conforming 4.49 with 1% discount.
All right.
Rock star, right?
That's great.
I mean, we haven't seen these rates since April, but I want to have some caution in here. And that's what I'm going to show you, because it's really important that you don't go, oh, well, interest rates are going down. They're going to keep going down. All right. So let's start last Friday, and we're going to kind of do this sequentially because there was a ton of it. And I'm going to highlight the things that you need to know that just happened this week that's affecting the psyche of your buyers, your sellers, interest rates, and ultimately could be home prices. So the European Central Bank on Friday raised their their central bank rate up 0.5%. It's the first time they've done that in 11 years, actually raise it. They've been coming down. It was negative 0.5%. I don't know how that works. Like if I put money in my bank, I actually have to pay to put the money in the bank. That's what that means. So it was negative 0.5 and now it's 0. That set up a whole ripple effect across the globe because all of a sudden now the European Union, and remember, this is a multitude of countries, they have one job. I talk about this all the time. It's kind of like my husband. He's got one job. They have one job, and that's inflation. They don't have the dual mandate like our Fed does because they're representing so many different countries. So they did this for the first time in 11 years, and that gave me the opportunity to do the video that we talked about where rates were dropping. We got to get in. This last weekend was a great weekend. This weekend's an even better weekend. Then the leading economic index came out and it dropped right there. You can see it, but it dropped from a high. Like it's still strong. It's just slowing down. These leading economic indicators are 10 metrics that are all pulled together to determine one number in how strong the economy is doing. And if you look at it, every time we had a recession, it dropped, right? But it had dropped before the recession, anywhere from 1 month to 7 months to 17 months. We had 2 head fakes here and here. Otherwise, every time it goes down, we do see that recession. It's one of the reasons why a lot of people, including Jerome Powell, said that he doesn't believe we're in a recession yet. This is just happening. It just went down 1.9. Year to date, we're down 1.8. Very similar. So as we see that drop, we're going to be watching for this upcoming recession. And why do we even care? I mean, this is when we're going to start to see interest rates slow down. This is hopefully when we're going to see inflation taken care of. Now, inflation, we have determined, yes, we are mitigating it. We're seeing commodity prices go down. We're seeing gas prices go down. We're seeing a ton of sales happening right now. And we're seeing home prices shift down a little bit. All of that helps with inflation. Wage and housing, though, will make this inflation sticky. It's going to be a hard press to get it to come all the way down to the Fed target of 2%. Remember, that's their target. I mean, we're watching it, it's over 9 right now. And even though it's dropping, and I'm watching the core, and even though that's dropping, it's going to take a bit to get it back down to 2. So here are the 10 things that they're looking at. And primarily the reason that it shifted down slightly is because consumer pessimism about future business conditions, and I want to show you that in a second, moderating the labor market conditions, falling stock prices, weaker manufacturing, new orders, all drove that leading economic index down. Some more than others, but all of that came down. So the consumer confidence, it was down. It was down 2.7% month over month. But an interesting statistic about this consumer confidence, once you break it down, the present isn't really as bad as the future. So right now, and we keep hearing it, people are still spending. I'm still feeling okay. I'm just going to be a little more discerning. I'm not going to pay more than list for that house with the green walls and the shag carpet on the main street 2 blocks from the grocery store, right? I'm becoming a little more discerning. So they're saying in the future, I feel like a recession's coming. And we all know that we can create a recession, even though by economic numbers, it might not be a recession because expectations often drive economics. But the expectation of the future is lower than people's relative current. Now, this is especially true for the upper wage group. So the survey actually broke it down by wages as well. And those over 100,000, earning over 100,000, they are actually up. They're feeling pretty good because they're still seeing that they're able to purchase. Maybe some of their stocks are still doing well. Maybe they pulled out for cash, but they have money to spend. Remember, we have over 2 trillion still in savings from what happened the last 2 years. Now, that is not an equal amount, obviously, and there are those who gain more than that, but those making over 100,000 are feeling good. These are many of our home buyers. Walmart also came out this week. That happened. They are the large, this blew me away because I actually did not know this until this week. They're the #1 private employer in the United States. Did you know that?
I had no idea.
I didn't either. They employ 1 out of every 10 people. Or I'm sorry, 1 out of every 100 people. 1%. 1 out of every 10. Yeah, I can put 10 people on. But even 1 out of 100 was a lot to me. When I thought, okay, we had 200 people in that room, theoretically, 2 of them, which 2 of you work at Walmart? That's what I want to know. So 1 out of every 100. So they're the biggest employer, private employer in the United States. Their earnings were a huge miss. And what they're saying is those people who typically shop at Walmart are hyper-focused right now on food and gas. And their clothing sales are way down. Their electronic sales are way down. This is kind of, I think of this as kind of the realistic day-to-day mark on all of the consumer confidence numbers that we're seeing and the consumer spending numbers we're seeing. When you see Walmart have a huge miss like this, you know that it's really kind of coming into action. We also saw mortgage purchase applications down 18% year over year. Now, I look at this as opportunity. I get it, especially year over year. I mean, last year, the interest rates were almost 3% less. Well, less than that now, given the fact that we've got kind of a nice dip in interest rates this week. But realistically, I have to go back to 2015 to have the same level of mortgage purchase applications. So it's kind of dropped right down here. You can see it a little bit. So I put the line into where it is. So the mortgage purchase applications, they come in. Mortgage applications in general, including refinance, hit an 11-year low. That didn't happen for the purchase applications. That's because of the volatility with refinance. Home builder sentiment plunged its largest amount last week. I already showed this graph and I showed this at the Mike Sherrard event, but I wanted to tee this up because also obviously we're seeing those home builders who have that inventory now putting things on sale, finishing the basement. I just had a borrower come and he was getting the entire basement finished and he could use whatever lender he wanted. I mean, like they're trying to get these homes moved, but we also saw that we saw a softening in housing permits and starts last week. But new home sales were also down. That came out this week. New home sales and pending home sales for the existing home market. So new home sales dropped 8%. Now I'm looking at this and it's not awful. Like we just really kind of recovered from 2020 and 2021. And in fact, there was a report that was put out that showed this month, every single year going back to 2003. And this whole group, this blue, light blue and green is leading up to the housing bubble, this expansive new build construction. All the spec homes that were being built were happening and people were buying them and they were buying 5 of them all at a time and just crossing the hallway in the title company. But if I show the red line down here, I'm really kind of right on track with previous years. So we are kind of getting back to where we can compare to 2019, 2018, 2017, but the new home sales are down and that's a real thing. And it affects the buyer, or I'm sorry, the builder psyche. We also saw a record month of unsold inventory under construction. There was a lot of news hitting the cycle that we had over 9 months of inventory in the new build. Remember, this market is like 10% of the sales, but only less than 1 month of inventory is actually completed. Like you could literally close on it and move in. Most of it is still in process and it's the largest amount. I mean, which makes sense with all of the supply issues that we've had. And did you see that Hunan is shut down again after 4 COVID cases?
Oh, you're kidding.
They shut it down. So that's going to cause more supply chain issues and hopefully not put a negative push back up on inflation after Powell is already starting to get it a little bit under control. I don't want to say that it's completely under control, but it is. The core is moving down while the headline is moving up. The headline includes gas and food and energy. Pending home sales came out. This is an NAR number. It's a nationwide number and it's dated, right? So we know that this is looking at June. We're, almost through July at this point, but it was down. And interestingly enough, it was showing down 20% year over year, 8% month over month. And that's very comparative to what we were seeing in the Denver market. But they came out in their report saying buying a home is 80% more expensive than it was in 2019. That feels about right, given the increase in the equity that we saw. But a quarter of the people that were purchasing back in 2019 can't afford to do so today based on the median home prices going up and interest rates going up. We do have to continue to shift, to educate, to help our clients see opportunities like this weekend where I can do an FHA first, a CHAPA second, and a CHAC third. I mean, come on, you have no excuse when interest rates drop and we're literally giving money away when we can get people into buying homes. So Lawrence Yun had said home sales will be down 13%. That's his forecast in 2022, with mortgage rates expected to stabilize near 6%. He didn't check what interest rates did this week. Somebody will have to tell him. And steady job creation. Home sales should start to rise by early 2023. Now, this year is not over, and this drop in interest rate is not permanent. We will see more volatility as the year goes by, and if we end 2022 with a 6% interest rate, it wouldn't absolutely surprise me. I think we'll still see a lot of volatility between here and there before we head into a recession. Then there was the Fed meeting. That happened yesterday. That was on my tube all day between interruptions and meetings. I was continuously trying to watch what is Powell actually saying, because he did what he said he was going to do. Then it was a question of what was he going to say. And interestingly enough, he said a lot of good things. So they raised the Fed rate 0.75%. You guys probably heard that by now. I had a good friend and a real estate agent call me and go, I just heard interest rates went up and by a lot. And I go, that was the Fed rate. In fact, our interest rates are doing really good because we like when things happen as expected, right? It's the surprises that move the markets. So we saw 75 after 75 bips last month, after a 50 bip in May and a 25 bip in March. So we're seeing it step up slowly, and we need him to get it up too, not only to control inflation, But when we hit a recession, we need the wiggle room. I mean, you kind of need to be able to react. He's got to get this to a point to where it's a tool back in his tool belt. If you leave it too low too long, then you can't modify that Fed rate to help get us back out of the recession. So here's some things that he said. Fighting inflation right now is more important than the employment mandate. I mean, jobs are good. Softening of the labor market will be necessary to reduce inflation. We're already starting to slowly see that, and I'll show you that in a graph as well. But he knows that. He's like, look, we're starting from a really good place. We have 11.3 million job openings. We saw incredible job creation the first half of 2022. We're doing good there, right? If people want jobs, people can find jobs. We do have to have employment softening. We are going to have people being laid off, but we're starting from a good place. Recent rate hikes have been large and they've come quickly and they have not yet fully realized. That statement tells you that September, they're going to pull back a little bit. He's like, I got to let some of this play out. I can't keep racing through these, which is interesting because we first thought he was going to do 1%. He leaked it to the Wall Street Journal that he was going to do 0.75%, and he did what he said. The Fed is going to be super data dependent in September's meeting. Remember, they've got 2 months now, 2 months of jobless claims weekly, 2 months of GDP, or not GDP numbers, of unemployment numbers, 2 months of inflation numbers. So they're going to watch and see how this is realized over the next 2 months before making any decisions or making any headlines. And the balance sheet reduction is working fine. Like, we don't need to taper at any greater speed. It's a slow drip, and we're just going to leave that alone. We're not touching it. And the market's like that a lot too. So 2 weeks ago, when I showed this chart, I showed you that we were probably going to hit 3.25 on the Fed rate within the next 2 meetings. I mean, that was the highest probability. Now, after everything that's happened this week and the Fed meeting, that's dropped significantly. In fact, the biggest probability is only that we're going to hit 2.75. We're already at 2.25. So that's only a 0.5 point increase in September. So this is good. It's just telling us that it's working. He's expecting it to do its thing, and he's going to be able to start reducing or pulling his foot off the gas and allowing that inflation to come back down. If it does, I mean, everybody's crystal ball is broken at this point. This is the expectation and the goal, of course. GDP also came out. That was a negative 0.9. Now, I was thinking, and there were several thinking, that we were going to see as high as, well, as low as negative 1.6. The expectations were actually a little bit better than this, the formal expectations. So this was lower than expectations, but it was still, if you look at it, you're feeling good. And actually, I broke a couple things out from, this is like a huge 8-page document. Go for it if you want to drop in there, but I pulled out a couple things that I thought are pretty interesting. So if I look at actually what makes up the GDP, consumer spending is right here. It's up 1%. So the consumers are still spending, right? So consumers are still spending up 1%, which is further conversation about the fact that we aren't quite yet into a recession. Even Powell said himself, you can't really have a recession while you have continued job growth and consumer spending, which is what we've been saying. Now, some will say that it started in the first quarter, some will debate, and ultimately it will be called here in the next quarter or so. And we also saw, though, that the durable goods sales are down. So remember, during the pandemic, people switched. We're primarily a service-oriented country. They moved from services, all the vacations and the travel and the hotels and the going out to eat and all the experiences, into goods, everything that Amazon could deliver. Now that's shifting away, and we're seeing that because Amazon and Walmart and Target sales are down. So we're seeing people are not buying as many TVs, and they're going back to experiences. TVs, durable goods, all durable goods are down 4.4%, but services are up 4.1%. But the thing that I don't love is that the reinvestment, the business reinvestment, is down 13% because the cost of reinvesting is more expensive right now. Wages are more expensive. The cost of goods are still more expensive. And now the cost of borrowing, even as a business, is more expensive because the Fed rate's going up. Our mortgage rates are going down, but the cost of borrowing for our business is going up. So all of that is future growth and slowing that down. So Mark Zandi with Moody Analytics said, we're not in a recession, but it is very clear. It is clear that the economy's growth is slowing. We are moving forward, but barely. We're going to continue to see this. Jobless claims did come down 5,000, but they were revised up 10,000 from the previous week. So the previous week's numbers came out and then they further revised it up 10,000. So if we actually look at what the average is, we're still higher than that. So this is just saying the 4-week average is that continued jobless claims increase, which means people are being laid off. And we'll see that. We're already seeing it in the tech industry. We're seeing it in the mortgage industry. You're already seeing it in the real estate industry. We're seeing layoffs. We'll see more of that, especially when Walmart's earnings come down, especially low. We're going to see more of those layoffs before we see the rehires on the other end of this. But it is starting to happen. Continued claims, though, interestingly enough, was down because we've got 11.3 million job openings, and that's to be expected. Here's the interest rates. Yay. So, all right. So nationwide, they've come down. They are hovering just over 5%, 5.25% nationwide. Now, I already told you, we were talking about it last week. We're going deep. I'm making sure that your clients are given the best service, the best rates. I mean, when we're seeing 4.875, no points, 4.49 with a point, those are fantastic interest rates. And when we send out our email blast, I'll throw in all the APRs to be compliant. But those are the kinds of things that we can be talking to our buyers, because this is what I'm worried about right here. So while I talked about the fact that the 10-year treasury had come down to 2.66 and it had actually broken through the 25-day moving average and the 50-day moving average, and it actually broke through the 100-day moving average, it's kind of a big deal. This is the coupon prices. So it's opposite of the interest rates or the yields. This is bouncing right up against the 100-day moving average. And if we can't get it to go above that, then it will bounce back down and we'll see interest rates go back up. Now, I'm going to be watching this throughout the day, and I'm going to be watching it tomorrow. And I'll definitely make an announcement and let everybody know if we do break through this, and if we're going to see continued low interest rates for a period of time, I want you to know about that. But right now, I'm worried that this might be short-lived until I see that breakthrough or bounce back down again. So just be on the lookout, talk to your buyers, get them out this weekend while we can lock in this interest rate, and we can do lock-in shops if you're not under contract yet, because the alternative is still renting. This is the national number. We're up 6.7% year to date. Denver's up 0.8%, still rising. It's up 0.8% month over month, up 8.8% year over year. That's come down slightly from 10% and 12%, but it's still increasing. Landlords are still getting their money. Tenants are still paying more. The alternative is to rent, and I don't like that at all. So with that, I'm going to stop sharing, and we'll see if we have any questions. Got a couple minutes to spare. Super excited.
Let's check out the questions. I know no crystal ball, but do you have anything do you think 2023 will mirror 2022 with most activity done early in the months, January, April through May, then tapering off more likely with like 2021 with peaking later in the second quarter? Any insight? I think that we're going to see the normal seasonal cadence return next year as we start to adjust to having these higher interest rates. The bulk of transactions still happen January through June, and then we really pull back going through July, August, and September. October, November, and December tend to stabilize at that point, but I expect there to be the big run up in prices early in the spring as inventory is low and buyer demand is high. And then we start to see that really pull back as we get into listing in June.
Absolutely. So you guys, we're going to be coming back. Obviously, every week we decided that we're going to stay with Thursdays.
Thursdays it is.
Thursdays it is. So just so you know, as we roll into the rest of this year, we're going to be doing this every week on Thursdays. We are not going to have an Agent Ignite. If you RSVP'd for August Agent Ignite, we're moving it to September. Megan and I had so much fun hosting Mike Sherrard last week at Columbine Country Club. We're going to do something similar but different. We've got Patty Silverstein, who is a phenomenal local economist. She's going to be talking about all the things I talk about on a Denver level. She's been with the DMAR Economic Summit every year. She comes in. She's going to be doing a halftime report. She's going to be talking about what happened the first half of this year, and we're going to find a spot that's going to be fantastic. We're going to be doing breakfast, and this one is going to be 9 to 11. Last time we did 10 to 12. This time we're going to do breakfast 9 to 11. Make sure to watch for announcements on that and sign up. That will be in person. We'll still do the market update on Zoom and on Facebook, but I just love the in-person events.
Yes, I do too.
Just love the in-person
They
events.
drum up a lot of business. I love the in-person events.
So you guys, it's always a pleasure to serve. We do this so that we can earn your business, so that we can work with you and your clients and get you to the closing table. We have phenomenal products. I know the First American and Megan have done incredible things for my clients. I've even had to switch from other title companies at times, knowing that you guys could pull some magic out of hats. And I know that our clients are seeing incredibly fast closings with incredible success, earnest money guarantees, and the whole thing. So if you were looking for a lender or a title rep, make sure to give us a call, and we'd love to go to work for you.
Thanks, guys. We appreciate you tuning in each week, and we hope to see you soon at our closing tables, and we will see you next week. Have a great weekend.
Bye-bye.